Hi there, welcome back to the Equity Trust Virtual Classroom. My name is John Bowens. In this segment, we're going to be talking all about the Secure Act 2.0. The Secure Act 2.0 is a piece of legislation that was signed into law, part of a much larger Omnibus Bill known as the 2023 Consolidated Appropriations Act. In today's session, we're just going to focus specifically on the Secure Act 2.0 and the 11 provisions that I see as most impactful to retirement savings individuals and for our equity trust company viewers on this channel. Now, where does Secure Act 2.0 come from? Well, in January 1 of 2020, the Secure Act went into effect, known as the Secure Act 1.0. In fact, we have a separate video on YouTube all about the Secure Act 1.0 if you're interested in learning more about that. It made some changes to requirement of distributions. It also made changes to how inherited IRAs are treated from a distribution perspective. So you can check that out on your own following this video. Today, again, we're focusing just on Secure Act 2.0 and the 11 provisions. Now, important to understand that we're just talking about 11 provisions. There are many other nuances and provisions. There's, of course, some uncertainty and some questions still to be answered. So much more to be revealed on this piece of legislation. But we want to make sure we get out as much material unbiased as possible to all of our viewers and the public so that they can make an informed decision with respect to what is this actual law? What do I need to do to comply with it? And then, of course, most importantly, where are the opportunities? Right? We don't always necessarily want to look at, okay, where are the drawbacks of a piece of legislation like this, but where are the opportunities? Because the philosophy behind the federal government in passing this law is to encourage individual Americans to save more for retirement. And you're actually going to see from the very beginning that there's an opportunity here to be able to contribute larger sums of money to retirement savings accounts on an annual basis. Now, Equity Trust, we're not here to provide any tax, legal, or financial advice. We encourage you to team up with your tax accountant, your CPA, or other financial professional as you navigate these waters. Keep in mind that this is a brand new law, so it'll take some time for us to understand more. And as any law is passed, what happens is there's a period of time where financial services institutions like Equity Trust react to this. The public, you react to this and start to understand how this works and how it applies to you or doesn't apply. And then, of course, you have the Department of Labor and the IRS. So you have regulators that are also going to step in and provide information and guidance. So again, this is just the very start. Certainly keep your eyes peeled on our channel here for more information and education as we move forward. So let's go ahead and dive in to the 11 provisions. The first one, which I'm getting the most questions on right now which is of most interest to people is, okay, I understand that I could potentially contribute larger amounts of money to retirement savings accounts on an annual basis. And for those of you that have viewed our shows in the past, you'll know we talk a lot about compounding interest in the absence of taxation using self-directed retirement plans, IRAs, Roth IRAs, 401ks, to invest in alternative assets like real estate, private equity, private placements, oil and gas, other types of unique alternative assets. And so this concept of compounding interest in the absence of taxation is really powerful for a lot of our viewers. The challenge for some people is they can only contribute so much money every single year to a retirement account. And so they're looking for ways to contribute more. And the government is giving us an opportunity here to be able to contribute more to our retirement plans. So what does this all mean? Well, the first provision is all about the increase in catch-up contributions. And when I say increase, what I'm referring to is the catch-up contributions to IRAs and 401ks will now be indexed to inflation, whereas in the past, they weren't indexed and they were fixed. So you're probably already asking, what is a catch-up contribution? What's the difference between a catch-up contribution and a regular contribution? So let's talk about it. With an IRA, traditional or Roth, the standard contribution for 2022 is $6,000. For 2023, that amount will be $6,500. So why did it go up by $500? Well, during times of inflation, or really just year over year, you expect some degree of inflation. You expect some degree of the cost of services and the cost of goods to increase. So as a result, the IRS, the government, permits us to contribute a little bit more money than the previous year. Now, these IRA contributions do not always increase, but in 2022 over 2023, the amount will increase by $500 from $6,000 to $6,500. Then on top of that, there's what's called a catch-up contribution. See, when you turn the age of 50 or older, you're able to contribute an additional $1,000. That catch-up contribution has historically been fixed. Going forward, per the Secure Act 2.0, that catch-up contribution will be indexed to inflation. Now, I've read something that says indexed to cost of living adjustment, indexed to inflation. Relatively speaking, what we're talking about here is it's going to be indexed to, as goods and services increase in price, you should be able to contribute more as a catch-up contribution on an annual basis. So when you're under the age of 50, 2022, you're at $6,000 plus your $1,000 catch-up, which is $7,000. And then next year you have $6,500, so $7,500 if you're the age of 50 or older. And then beyond then, we're going to look at that $1,000 catch-up, and ultimately the IRS is going to provide guidance in terms of whether that contribution, catch-up contribution, will increase or not year over year. So stay tuned for more information on that. But the idea here is, as goods and services cost more, you should be able to contribute more and more money to an IRA on an annual basis. Now, there's also the 401k catch-up contribution. So 401ks, separate from IRAs, have different contribution limits. It's important to understand that you can contribute both to your IRAs and to your 401k or 401ks. So some people think they can only contribute to one or the other. You can contribute to both. So with a 401k in 2022, as an employee, you can contribute $20,500. When you are, for next year, 2023, you can contribute up to $22,500. So there you see that that base contribution is indexed to the cost of living adjustments, and so it is increased year over year from 2022 to 2023. Now there's this catch-up contribution, and the catch-up contribution is typically $6,500, but next year it will actually be $7,500. And then that catch-up contribution of $7,500 will also, just like IRAs, be indexed to inflation or the cost of living adjustments. So again, what that means is potentially being able to contribute more money to our retirement savings accounts on an annual basis. So when we look at 401ks combined for 2023, you can contribute $22,500 as your base contribution. And then if you're 50 and over, you can contribute up to $7,500. And then beyond then, once this catch-up increase indexed to inflation cost of living adjustment phases in, you could potentially contribute more than that. All right, there's another variant. This leads us to provision number 2 that we want to talk about, and this relates to the 401k catch-up contribution. For those that are of the age of 60 to 63, all right, so once you get to 60 to 63, and this is going to start in 2025. Okay, so starting in 2025, again, some of these are phased in. They're not going to start January 1 of 2023. So if you call your 401k provider and you say, hey, I want to do this extra catch-up contribution, they're going to tell you, no, you can't do it yet. We don't have the guidance. We don't have the infrastructure, right? It takes time for financial institutions to build the systems and all the technology. So the government is giving the public and the financial services institutions time to react to all this. So starting in 2025, if you are the age of 60 to 63, you're going to be able to make a increased catch-up contribution, which will be the greater of $10,000 or 150% of the standard catch-up contribution. All right, so to not get too far into the details, just think you're 60 to 63, beyond 2025, you're going to be able to do your standard base contribution to your 401k. Let's say it's $22,500. And then you can do a $10,000 catch-up. So instead of only being able to put $22,500, you could do $22,500 plus $10,000. So that gets you $32,500. So why did the government do this? Well, the philosophy behind this is for those that are 60 to 63, you're in your later years of working and be able to max out, be able to put more money into those 401ks on an annual basis. Now, I will tell you that statistically, Americans are only putting away approximately half of what they can to retirement savings accounts. More specifically, let me say IRAs, only contributing half. And that's from a Government Accountability Office report that was done in 2015. In fact, you can check out a blog that I wrote called The Great Retirement Savings Crisis. And it talks more specifically and gives you some cited references to that data that makes the argument that, let's face it, folks are not maxing out their retirement savings accounts. So the hope here is that people look at this opportunity and say, okay, it makes sense for me to put money away into tax-deferred savings accounts or even possibly tax-free Roth savings accounts for my future. Keep in mind that once you're done working and you don't have any earned income, you don't have any W-2 or actual earned income, you can't contribute anymore to retirement plans. So the idea here is just contribute as much as you can into those various buckets, 401ks, IRAs, maybe even a health savings account while you can. All righty, so that's number 2. Moving on to number 3, with catch-up contributions that we just talked about. With 401k plans, okay, with 401k plans and other workplace plans, starting in 2024, if a worker's wages are over $145,000, and this will be adjusted as well to inflation going forward, so it'll start at $145,000 in 2024, and it likely will increase beyond that. Ultimately, if you make more than $145,000, your catch-up contribution, so that's $7,500 to a 401k, the catch-up contribution, or for those that are 60 to 63, again, you have the $10,000. That catch-up contribution will have to go into an after-tax Roth bucket of the 401k. So you can't put it into the tax-deferred bucket and get a deduction. You got to put it in the after-tax Roth bucket. Now, for some people, they're okay with that. They're not interested in a tax deduction. They want all of their contributions, in addition to their catch-up, also their base contribution, they want that to go into an after-tax account because they would prefer to pay taxes on the seed so they don't have to pay taxes on the crop. So this provision, number 3 provision, will be beneficial. I guess it will be beneficial to some folks, and other people will potentially look at as a drawback. I will tell you, many of the folks that I talk to, they're not all that concerned with this provision because they were planning on making those contributions to the after-tax Roth bucket anyways. All right, so again, in recap there, if you make over $145,000, your catch-up contribution must go into that Roth bucket of the 401k or other workplace retirement savings account. All right, number 4, simple IRA plans. So if you're not familiar, simple IRA plan stands for Savings Incentive Match Plan for Employees. So if you're a business owner, you want to contribute maybe a little bit more money than you can to an IRA, but you don't want to open a 401k for you and your employees, you can look at potentially a simple IRA, providing you meet all the eligibility requirements. And the catch-up contributions will also be adjusted to inflation or the cost of living adjustments. And then there is a 60 to 63 provision, just like the 401k, where you can contribute the greater of $5,000 or 150% of the catch-up amount. So what they looked at is they said, okay, if we are allowing this in the 401k, we should also offer something for business owners who have simple IRAs. That takes us to provision number 5, which relates to another business retirement savings account known as a SEP IRA. So SEP IRA stands for Simplified Employee Pension Plan. So SEP IRAs and simple IRAs, contributions could be made on an after-tax basis instead of pre-tax, also known as tax-deferred basis. This is an interesting one. So what they're saying here is, historically, with a SEP or simple IRA, all of your contributions, all of your deferrals, so to speak, employee, employer, were tax deductible, okay? And they grew tax deferred. And eventually, when you take money out of the plan after 59 and a half, which is qualified retirement age, you would have to pay taxes. So they're all tax deferred treated accounts. What they're saying here is with the SEP and simple IRA, should the individual elect to do this? So should you elect to do this, instead of getting a tax deduction, you might say, I want to put the money in after tax on an after tax basis. It grows tax free. And then when you take the money out, you pay 0% tax. So as long as you follow the rules, you reach 59.5 and you don't engage in any type of prohibited transactions, you can take all the money out tax free. So this can be very attractive to those, again, that would prefer to pay taxes on the seed so they don't have to pay taxes on the crop. All right, this takes us to number 6, which this is another one. Number 1 and number 6, I'm getting the most questions on right now, and that is required minimum distributions. So what are required minimum distributions? Well, with a tax-deferred account, like a traditional IRA, SEP IRA, simple IRA, tax-deferred 401k, right now, as it stands, the required minimum distribution age is 72, meaning when you turn 72, you have to take a percentage of the money or assets out of your retirement plan, your IRA, 401k, or other tax-deferred account. And it's based on the IRS published life expectancy table. In fact, if you want a deeper dive on required minimum distributions and what that calculation looks like, we have another link to another YouTube video here, which talks specifically about the required minimum distributions starting at 72. So what the Secure Act 2.0 is doing is over time, it's going to phase in an increase in that required minimum distribution age. So it's going to start beginning after December 31 of 2022. So call it January 1 of 2023. That age will go from 72 to 73. Now, why did they do this? Well, the thought behind it is folks may be working maybe later into their years, or maybe they don't need the money in their retirement plan, right? And they want to save it for longer term. And of course, people are living longer. So the idea is allow people to retain that money in their retirement plan and not force them to distribute it starting at 72. So delaying it to 73, again, that starts January 1 of 2023. And then it'll phase into the age of 75 beginning after December 31 of 2032. So think January 1 of 2033, that age is going to go to 75. So for example, if someone turns 74 after December 31 of 2032, then the applicable age will be 75 years of age. Okay. Again, for more information on required minimum distributions, you can check out that separate training video. Keep in mind that Roth IRAs do not have required minimum distributions. Also, and we're confirming some of this information, there should be a provision that will allow people that have balances of under $100,000 to not have to ever take a required minimum distribution. Meaning you could be, let's say, 80 years old, and let's say you only have $90,000 in your traditional IRA, and you don't really need to take the money. Well, the government will say, okay, you don't have to take a required minimum distribution because you're under that $100,000 amount. Again, that's another one of those items that more information will come as we go forward. All right, number 7, employer matching of student loan repayments is allowed. This one's interesting. So in 2024, employers can match student loan repayments as if the student loan repayment was a deferral. So we don't have the specific amounts and all the nuances of this, but the idea is Americans who are looking at, should I pay my student loan or should I put money into a retirement savings account? Or maybe it's, I don't have the money to do both. I can only pay my student loan and I don't want to default on my student loan. So I'm just not going to contribute to retirement savings accounts. And so the government is saying here that, okay, we will have employers, if an individual is paying their student loan, the employer will match that amount, deferring that money into the individual taxpayer's 401k. This is another one of those. More information will come on how does this actually work? How do 401k providers assess? How do you certify whether someone is actually making the student loan payment or not. There's going to be a lot of work to be done on that for financial services institutions, HRAS systems, and other people that are going to be involved. All right, number 8, longer-term part-time workers qualify more easily to participate in 401k plans. So under current law, employees with at least 1,000 hours of service in a 23-month period or 500 service hours in a 3 consecutive periods must be eligible to participate in the employer's qualified retirement plan. The SECURE Act will reduce that 3-year rule to 2 years for plans starting in 2025. So for those that are part-time employees, there's going to be more access or more sooner access, if you will, to being able to contribute to that 401k under that company. All right, number 9, penalty-free emergency distributions up to $1,000 will be permitted from retirement plans. Once every 3-year, there's going to be a once every 3-year limit on this, or once a year if repaid within 3 years. I know that might sound a little bit confusing. This is another one of those. More will be revealed as we move forward. The point is the government wants to give, the philosophy behind this is allow people to be able to take money out without penalty if there are dire circumstances that arise. Now, this one is interesting. I'll add a little bit of commentary here. Folks, I want you to be very careful. Taking money out of retirement plans should be an absolute last resort. Unfortunately, there has been this conditioning effect that I have seen in society with respect to retirement savings accounts. When the going gets tough, people want to raid their retirement plans. In 2020, there was a CARES Act provision known as the Coronavirus-Related Distribution Act. And what it did is it allowed people to actually take money from their retirement savings accounts. And it ran rampant. I saw lots of people take money from their retirement savings accounts when they didn't need to do it. Keep in mind that your IRA, your 401k, your retirement savings accounts are highly tax-privileged retirement accounts. You can leverage compounding interest in the absence of taxation. You can invest in stocks, bonds, mutual funds, real estate, private equity, private direct investments, cryptocurrency, gold and silver. There are all of these options that are available to you. And the only way to get the tax advantage tax treatment is to keep the money in your retirement savings accounts. Keep in mind that once you take the money out and you don't return it within a specified period of time, if you don't follow the rules, then you're never going to be able to get that money back into a retirement savings account. So make sure that you're cognizant of this and you're using your retirement plans for, if you will, the here and now, only in situations where there are dire circumstances. All righty. This takes us to number 10. So number 10, automatic enrollment requirements. So effective in 2025, workplace plans like 401ks must automatically enroll employees when eligible. So this is known as the automatic enrollment requirements. This again goes into effect 2025. So think of it this way. As an employee, you're not opting in to the 401k. Your employer is opting you in. Now, can you opt out of the plan? Absolutely. You can opt out of the plan at any time, from my understanding, based on the way the law reads. But the employer is going to automatically, once you're eligible, opt you into the plan. And the law does specify that it will start no less than 3% of your wages, and then no more than 10%. There is another provision that references 15% given certain circumstances, but by and large, we'll say 3% to 10%. So no less than 3%. It would start at 3% in the first period, and then it would increase over time. All right. So as a employee, you have a 401k with a company if they offer that opportunity, and they will automatically be enrolling you into the 401k, and money will come out of your paycheck and go directly into that 401k. The philosophy behind this is this should encourage Americans to save more for retirement. And the theory is people are less likely to, let's say, opt out than they are to opt in. Now, that's going to have to withstand the test of time. We'll see whether people actually allow that to continue, or if we find that people just opt out of the plan and it didn't really have the impact that we thought it would have. But the hope, of course, here is that Americans recognize how important saving for retirement is. And that's been one of the biggest challenges in society that we have found, is that, people don't appreciate enough sometimes the ability to be able to save into these tax advantaged vehicles, such as an IRA or Roth IRA, SEP IRA, or 401k. So the hope here is that people will contribute more and continue to do that, so that they're not as reliant on Social Security, which obviously has a lot of challenges, and other means of financing their future. All right, number 11, non-highly compensated employees can contribute the lesser of 3% of compensation, or $2,500 post-tax, to an emergency savings account, and if needed, take funds out when needed without penalty or taxes. So essentially, there's going to be another bucket that's created, this emergency retirement savings bucket. And you'll be able to contribute to this account post-tax. So think of it like a Roth, grows tax-free. I'm assuming eventually you can take it out tax-free or roll it over to a Roth IRA. Obviously, more will be revealed as we move forward with that. And then that money would come out tax-free if you have a situation where you do have a legitimate emergency. All right, so that was our 11 provisions. Now, I do have a 12th item in here. Okay, I'll call it a bonus item that I want to mention. So currently, plans may automatically distribute small accounts of less than $5,000 to former participants. So you'll hear of these automatic rollovers. So where if you have a small balance in a 401k and you leave your job, they actually can force a rollover to another institution. So without you even knowing or acknowledging, well, they should note it. They do provide a notice to you, but without you acknowledging, they essentially just roll the money over to an IRA, and then you got to go out and try to find this money. So under this provision, under the current law, if greater than $1,000, they can roll into an IRA without the participant's consent. This limit, 12 months from enactment, will increase to $7,000 and permits the transfer of default IRAs into the participants' new employer plans. So there's still more information to really to obtain and to understand there. The reason why I put it in there is because I just want everyone on today's call to acknowledge that if you leave a company and you have a small balance in your 401k, they could potentially, without you even consenting or acknowledging, they could just roll that money over to another financial institution. And you'll get a notice, of course, but what happens if you move, or, emails change, things of that nature, and it may be difficult for you to find that money. And there are many instances where folks cannot find where their money is. There are some resources that the government has to help people find their orphaned 401ks and retirement plans. But by and large, you want to stay on top of that. If you leave an employer, the natural progression is to roll the 401k over into an IRA. So we went through the 11 provisions, gave you a bonus provision there, number 12. Keep taking advantage of our YouTube training videos. More will come in terms of this legislation. We'll make sure to provide more information and education to you as we get more information and more education on the topic. Make sure, if you haven't already, to subscribe to our YouTube channel. If you hit the little bell icon, anytime we release a new video, which is almost weekly now, you'll get notification of that video training. Here at Equity Trust Company, we're here to provide education and information so that you can make an informed decision on using a self-directed IRA, 401k, Roth IRA, or other tax-advantaged retirement savings vehicle to invest in traditional and non-traditional, known as alternative investments. Again, I'm John Bowens, Head of Education here at Equity Trust Company and Investor Success. Until the next session, keep leveraging compounding interest in the absence of taxation. Thank you.